So you need to think different. Don't listen to the hedge fund folks. Hey there, Lincoln here from bullacademy.org. Today I want to talk to you about hedge funds. I had the pleasure of speaking to a hedge fund employee this weekend. Happens to be an old friend, and I got the sense that hedge funds all think they're better than us retail investors, us Americans who work hard and try to build a better future for ourselves and our families. And the reason they think they're better than us is because they have a bunch of money, a bunch of models, and a bunch of theory. And they want you to believe that you shouldn't even try to beat the market because there's a bunch of math that says in theory there's perfect market efficiencies and the market will always win. You will always do best by just buying the market index and just going along with the flow. But as we always say on this channel, the majority is always wrong. And that's because the majority is doing what everyone else is doing, and they're all going to get the same result, which is mediocre. So I had this conversation with a friend, and I was in a group of four. There was four of us, all very smart people in their own right, and we're having this conversation. It goes on for an hour or so, maybe 2 hours in a park in the evening in Brooklyn, and we're discussing risk-adjusted returns. And the friend says you have a better risk-adjusted return if you just buy the S&P 500 and let that be. Don't try to invest the majority of your portfolio in specific individual stocks because you just won't beat the perfectly efficient market, while he also admitted that the market isn't actually efficient. So again, we're trying to balance here theory and actuality. Wherein theory says the market is efficient, so you can't beat it. There is no advantage that you have over the very smart people out there who have billions and billions of dollars and went to all the Ivy Leagues and now have all the advantage over you because they're just very smart people. I just finished the history of the USA in 5 crashes. In every single crash, very smart people caused those crashes. Every single crash. All 5 of them. And all of the others. Very smart people caused those crashes. And that's not even the point of this video, so let me just get back onto it. They try to tell you, hey, we're very smart people. We can't beat the market index. So you, dummy, not very smart person, why do you think you can beat the market index? And in this video, I want to just tell you what your advantages are over these hedge funds who think they're better than you just by the virtues of having more money and having a bunch of models and theories. So in this conversation, my friend tells me, oh, I have this colleague who sets up a bunch of stuff for these big companies as they move around the country and expand. And so he obviously has more of an advantage over you and other retail investors who don't have those insights. Because you don't work for hedge funds and you don't set up big technology stuff for major companies that are moving around the country and are moving around the world and are expanding. And so when he sees these companies moving into new regions, he'll immediately have this insight that the rest of the market does not, because he's the one setting up these things. I'm trying to stay obscure here because I don't want to give away my friend's identity. Setting up these things for these big companies. And so when he sees, say, Amazon moving into this new city, he can say, oh, wow, Amazon is expanding. I now have this insight that all the not very smart people out there who are trying to beat the stock market index don't have. And so now I'm going to go buy up Amazon and run up the price. And because I have billions of dollars, I'm going to drive up the price so much that there is no more room for anyone else to have any upside potential if they try to invest in this company too, in Amazon as well. Okay, that just isn't true. Even if this guy has this incredible insight that no one else has, and he buys up 5% of the float of Amazon, that doesn't mean you can also buy up Amazon and have upside potential, because you are two different people. He might be trying to do a quick flip, or he might be working for a hedge fund, and hedge funds have a responsibility to their clients, which is the first responsibility is to maintain their money. I know my friend wouldn't say that. He doesn't believe that his job as a hedge fund is to maintain wealth, but that's their primary goal, to not lose money. So this guy over here who has all these insights that you don't apparently, and has all this money and is very smart, he's going to buy up all of Amazon, and you won't have any room for upside gains, upside potential. Just by the virtue of him being very smart and having lots of money, he's going to run up the float and absolutely wash you out. If you were to believe that, what he's telling me, then you must believe that there has been nobody, no retail investor that has ever benefited in a meaningful and material way from investing in individual companies. And they have no chance, no shot at even getting a better return than just investing in the S&P 500, because there's these hedge fund employees out there who have all these insights and all this money to completely take over all of the upside potential of a company. You must believe that, if you believe what he's telling me. And if you do, I have a Brooklyn bridge to sell you. It's a beautiful bridge. You might want to buy it. I mean, I do have to say that's not true. That none of that's true. So now let's get to your advantage over this special guy, very smart guy with the special insights and all the money. What's your advantage over those hedge fund guys? Well, one, your first advantage is that you are dealing with much smaller funds. Your upside potential is much greater than theirs. Let's say you have $1,000 in your bank account. You want to double that. That will get you to $2,000. That's 100% return in a year. $1,000 to $2,000. 100% return. Now, this hedge fund with $100 billion wants to move 100% in a year. They have to get to $200 billion. Much bigger numbers. It's just as impossible unless they're taking insane amounts of risk with money that isn't actually theirs. And remember, their primary goal is to preserve, to not lose, because if they lose, then their clients will see that they've lost money. And they didn't go to these very smart people with all the billions of dollars and all of the models and theories to lose money. And so the hedge fund, their job is to preserve, to make sure at all costs that they don't lose client money. And so they're not taking insane risk. And here's the other thing. They're trying to beat the stock market index while also investing a large percentage of their funds into the stock market index. That's like trying to beat the other team in basketball while shooting against your own rim, your own basket. You can't do that. You can't put a majority or a plurality of your funds into something and then say you're trying to beat that thing. That's what they do. If they're trying to maintain wealth, to not lose at the first and foremost goal, they're invested in the stock market index, the S&P 500. That's what they do. There's no arguing that. And my friend, even with his risk-adjusted returns model and absolute efficiency in the stock market, he, as a hedge fund employee and a quant of sorts, he said it himself. They're invested in the S&P 500 because if you want the best risk-adjusted returns, invest in the S&P 500. That's what they do. But you don't have to, because you don't have any money. You're poor. You're broke. You have $1,000 or $100. You want to move $100 to 100%? That's $200. You want to move that $100 10x? You're getting to $1,000. You've done 10x. If they want to do 10x, if they want to do 10x to move from $100 billion to $1 trillion, that's their 10x. That's their 10x. Your 10x is $100 to $1,000. Theirs is $100 billion to $1 trillion. Much different world. So this whole comparison my friend was trying to make and trying to tell me, oh, you can't do it because we can't do it. We're the very smart people. We can't do it, which means that you can't, because we have all these insights with our guy over there who installs all these things for these big companies when they're expanding around the world. So he knows what more than you do because you're not there. You don't have those insights because they don't trust you to do their very smart work. You don't have to. You're not them. You have a different goal. You have a whole different situation. So that's number one. You move 10x from $100 to $1,000. That's possible. That's 10x. The S&P 500 does 10% on average at best per year over the last 100 years or so. Whatever the stats are, you get about 10%, anywhere from 7 to 10% on average. At best, 15, maybe even 20 at best percent. So if you invest in the S&P 500 at 15% returns every year for 5 years, you will achieve 100% return, a doubling of your funds that you invested over 5 years. You will have taken $100 and turned that into $200 over 5 years because you listened to the hedge fund who told you that, hey, stupid, I can't do 100% in a year, so you shouldn't even try. You can't do that. 5 years to move $100 to $200 because you listen to the hedge funds who have an entirely different situation than you do, and you put all your money in all your broke money. You don't have. I'm in the same boat as you. We're poor. We don't have that kind of money. We're not trying to move the seas. We're trying to move our tiny bank accounts 100%, 500%, and 1,000%, 10x. Or I guess that's 900%. We're trying to move it 10x. We're trying to get 100 or even 1,000. We're trying to get $1,000, 10x to $10,000. If it takes you 5 years to turn $1 into $10, oh, sorry, not even $10. If it takes you 5 years to turn $1 into $2, you're not going to make it. That's what the crypto folks say. And you see what they're doing? They're not making it. So you need to think different. Don't listen to the hedge fund folks who tell you, oh, the world is too hard out here. We're the very smart people. We obviously are having a hard time with all this money, all this. Oh God, it's so tough. We have all this money. We have all these brains. We have all these accolades, all these models, all these theories, and we can't do it. We can't do 100% return in a year. What makes you think you can? Are you LeBron James? Are you Warren Buffett? Are you Peter Lynch? Can you do the impossible? You don't have to, because you're broke. All you need to do is move $100 to $200, or move $100 to $1,000, and then move $1,000 to $10,000, and then move $10,000 to $100,000, and then move $100,000 to $1 million. Those are 10x returns that are incredibly possible because you're poor. You're not dealing with $100 billion. That might take you 10 or 20 years to get from 1,000 to 100,000, but it's possible. And of course, you're going to continue to work and add money to that, and over time, your money will compound, your interest will compound, all the yields that you've gained will compound because you stay invested. And so that brings us to number 3, your third advantage over these hedge funds. You have time. You have time. They don't have time. You have time. Time in the market beats time in the market. Hedge funds have to show their clients returns every year and show them that, hey, not only am I not losing your money, client, but I added 5% to it. I added 6%. I added 7%. Over 10 years, I'm going to add, 200%? Whatever. I doubled your money twice over 10 years. Whoop-de-doo. I did it. 200%, two doubles over 100 years? Or two doubles over 10 years. If you double your broke bank account twice, only twice over 10 years, you are never going to retire. And so these hedge funds, they have to show their clients returns every year. And if they show them a loss, they're getting cut. Their clients are leaving them. And so they don't have time. They have to watch every move they make. And if it starts to get scary, if they start to see that their returns might dwindle because there's a market cycle, if they start to see that the investment they made, the trade they made at the start of the year is now down to only 10% return and is risking going into negative returns in the short term, they have incentives to cut that trade because they won't lose their job for getting out of a trade early. They won't. That's well known in finance. You won't lose your job for quitting early. You will definitely be going through a performance review if you fail to avoid negative returns, if you fail to not lose your clients' money. If you lose your clients' money, you will most certainly be at risk of losing your job. So your number one priority, just like the cops, is to save you first. Save yourself first. Don't risk losing clients' money, or you risk losing your job and your way of life and your reputation, because no one wants to work with an analyst or a hedge fund manager who has lost money in the past. They can't give them their money. They can't trust them to not lose the money in the future. And people who are rich, people who are incredibly wealthy, their number one concern is preserving wealth. But you're poor. You're not in that stage yet. Remember, we've discussed this many times on this channel. There are two stages to wealth. Number one, this is where you are. You're poor. Number one is to accumulate, is to build wealth. And then once you have that wealth, stage two is to maintain it. That's retirement. That's what we call retirement. You maintain that wealth. It yields you enough income every year in dividends to sustain your lifestyle at whatever level you want to be, whatever level you can afford, I should say. So hedge funds and their clients, they're over here. They're in stage two. They're in wealth maintenance. Of course, there's greedy people out there who, and that's not a bad thing. That's not a negative thing. People want to accumulate wealth. That's just natural. Some people just want to keep building wealth. That's fine. So some of them are in there, and they want to take a little bit of risk so that they can add on to their wealth. But most of them, the vast majority of them, are in the wealth maintenance stage. Don't even look over there. You can afford to look over there. That if you look over there, you're gonna get a you're gonna get an overdraft charge from your bank because you're not even in that world. They have to make sure that they are only in the market as long as they can be. They are only in an investment as long as they can be, or risk losing client money. So they don't have time. If things start to go wrong, that's why you see them on CNBC all the time talking about, oh, what are you selling today? What are you buying today? What are you selling today? What are you buying today? That's timing the market. What are you buying this quarter? What are you selling this quarter? Is there going to be a crash every day? Is there going to be a crash? Are you afraid? And that's why I say you have time. That's your advantage. You have time. You put in $100 that you can afford to lose. Right? If you make $1,000, you take 10% of that, maybe even 15%, which is recommendation by the very smart advisors, right? So I get to my friend, very smart people told all of us that, hey, put 10% to 15% of your money that you make, your income, into investments such as equity, stock market. So you take 10% of your income, you put it into the stock market because you can afford to lose it, and you don't need it for the next 5-10 years, and you say, hey, $100, go to work. I want to see you double next year. And so $100 goes to work, it turns into $200. And then you say again, hey, $200, I want to see you 10x now. Yeah, $200. You've learned some things. Let's see 10x. And if you just hold on, you don't panic, you don't sell your stocks because the market has has volatility and is fluctuating, and you saw your stock go from here to here, if you don't sell, that hedge fund's going to sell as soon as they start to see that they're going down. If they go down too far, they risk losing their job because their client cannot lose money because their client is in wealth preservation mode, wealth maintenance mode. They cannot lose money. I want you to remember that. That's the main thing here. My friend denies it, but that's their thing. I don't know why he denies it, because it's a well-known thing. S&P 500 is very safe. And most people should be in the S&P 500. That's true. I agree with him there. Most people should be investing in the 500, the S&P 500. But you're not most people. You're obviously watching this channel because you're not most people. You want to retire before you're 65 or 70, 80 maybe, because most people don't even get to retire because they're told that you can't do better than hedge funds, and so don't even try it. Or they just never even learn that they can do better than just a savings account and just the S&P 500. And so you stay in the market, you stay invested through all the ups and downs. You keep dollar cost averaging in, dollar cost averaging up and down. And maybe if you get scared a little bit, 1 year you say, okay, I'm just gonna chill, relax a little bit, and put my money in the S&P 500. Be a little safer this year. See where things turn out. That's your fallback. But if you stay in your high growth investments through the ups and downs, you have a much better chance than anyone else who invests in the S&P 500. If they do 15% every year for 5 years, they will double. And that's fine. But you don't want to wait 5 years to see your bank account double because there's nothing in there. So you want to see it double faster. And I'm here to tell you again, you can do that. You can turn 100 to 200, you can turn 200 into 2,000 just by staying invested through the ups and downs. The hedge fund, they can afford to just close their eyes and stay in the market because remember, clients are watching. And clients will say, hey, what happened there? You lost 1% that year. You told me you would give me 6% and maintain my wealth and beat the inflation rate. You didn't do that. Should I go call Charles Schwab? And they'll say, no. We apologize. We're very smart people. We have all the models and all the theories. Just give us a chance. We fired that guy who did that, who didn't sell your losing positions early. We fired him. He's gone. Don't worry about him. Very smart guy, but obviously not smart enough for what we need to give you. So we got rid of him. He didn't have time to stay in like he thought he did. He thought he was a retail investor who could just close their eyes and just look away from the market when it turns down. He's not that. And that's why he got fired from the hedge fund. But you don't have to be him. You have the luxury of time. My friend didn't seem to understand it when I said it. I was saying, hey, one of my advantages is time. One of my advantages is time as a retail investor. I don't have anyone. I'm not beholden to anyone but myself. And since I'm young, I don't have a family to have to worry about. So I can take greater risk than the hedge fund. That didn't register with my friend for some reason. But I hope it registers with you. You are young, you are broke, you are poor, you have no money that you need to worry about maintaining. You need to invest. And you need to invest aggressively. Not as aggressively as I do, of course, because most people should not be doing that. I have the luxury, again, of a very high salary that I can replace if I lose it for some reason, given my job. But I do understand that I am a outlier. So I want to always lead with that. Don't just do whatever I do. But I'm not just talking about what I can do. I'm talking about what we all can do as broke retail investors who are nowhere close to retirement. And that is invest in growth, not invest in dividends and 15% returns or 10% returns and be safe and not lose any money and not risk anything and not get the best risk-adjusted returns. And remember, risk-adjusted returns, that's a afterthought. After you've done the investment, you look back and say, what was my risk adjusted return? And you say, I got $5 million from doing what Lincoln suggested and investing in growth. But I took lots of risk. That was a risky move. I could have just invested in the S&P 500 and got $1 million. That would have been a much better risk adjusted return because I didn't take any risk or very low risk because it's very safe, which my friend denied. That safe word, he didn't like that safe word. But that's what it is. It's safer. And that's why I got $1 million and I got a better risk adjusted return. It's literally in the definition. It's a better risk adjusted return. And so I made $5 million being taking more risk and got a lower risk adjusted return by staying invested in the market over 10, 20 years versus making $1 million. I don't care what the risk adjusted return is in that case. I made 5x more than you. I made 5x more than a person who's trying to preserve their wealth. And I should. Because they're trying to preserve. Why should I not beat them? I'm trying to grow. They're just preserving. They're staying still. Imagine not overtaking someone who's running on the track or who's walking on the track while you're running, while you're trying to run. You're thirsty. You're trying to get to the finish line so you can get some Gatorade. They just came out of their penthouse where they have all the water, all the Gatorade, all the fancy drinks. They're just walking their dog around the track. They're chilling. They don't have a job to get to on Monday. If they want to sleep in, they can sleep in. But you need a drink. You're thirsty. We're at number 4. What's our fourth advantage over the hedge fund? And this is where Peter Lynch comes in. Peter Lynch, great guy. 29% returns over 13 years. 29% returns over 13 years annualized, right? Every year, on average, he did 29% returns at Fidelity Magellan Fund. So he was a very smart fund manager. But he understood that in order to actually build wealth, you have to be different. You have to take more risk. You can't just invest in the S&P 500 and say, okay, I'm going to get the best risk-adjusted return if I just do this. What he noted in his book, One Up on Wall Street, was that the retail investor has a great advantage over these hedge funds. Or he listed a couple, but the main one was that we actually use these products. We use the things we invest in, or at least we should. We should understand those things. If you're investing in a company, remember the bull mentality that we talk about on this channel all the time, that we preach here. We coined. The bull mentality is that we know what we invest in. We understand what we invest in. We believe in what we invest in. And we hope for the long term. Because that's how we build wealth in this country. That's how we give ourselves the best chance of success in the stock market. I don't say that for no reason. I didn't make that up out of nowhere. Each one of those points are meaningful. You should really understand what you're invested in and have familiarity with it and believe in it. Hedge funds don't believe in anything. All they know is their models and their theories and whatever surveys say. They don't actually use these things. That guy who's installing the fancy stuff for Amazon as they expand around the country, he doesn't know what Amazon does. He hasn't ever used it. But maybe you're a software engineer in 2006, 2008, 2010, and you're seeing Amazon building out AWS, and you're using AWS at work every single day, and you see that there's nothing like AWS out there, and they continue to build on top of it. And you look at their revenue, their quarterly reports every quarter, it says that AWS continues to make more money and be more profitable than the actual Amazon e-commerce business. And you see that. So not only do you see from your day-to-day work as a software engineer using AWS, Amazon Web Services, that it's leaps and bounds better than the entire field, and it makes your life easier. Competition is years away. You'd be stupid not to invest in Amazon, at least AWS. To my friend, I would have invested in AWS if I was a software engineer back in 2006, 2008, 2010. If I was a software engineer building web services using AWS after using the competition or whatever came before AWS and seeing that AWS makes my life incredibly easier. If I was the same person I am today, I would have invested in Amazon Web Services if I had known. I was a kid at the time, so I didn't, right? I had no clue what was going on. I was a software engineer. I had no idea how that world worked. But now I'm a software engineer. And I have the chance to invest in a similar business, a similar offering in SoFi, Galileo. I use SoFi. I've used their many products in their one-stop shop online bank. The only one-stop shop online bank that is actually a bank. I've used it. And I understand how web services work and why they're so profitable. So an engineer who is building with Galileo has a much better insight into how this product works and its advantages over the competition than that fancy, very smart guy who's installing the whatever as they expand around the country. The engineer who is using the technology knows better than the people who don't use the technology. And so the people who use the makeup know better than the people who don't use the makeup because they've tried the many options and they see that Sephora is better than everyone else or whoever. I don't know makeup too much, so I just would have picked up whatever name came to mind. Let's go Sephora. If you're a lady, you've used many makeup products and you have an idea of who is the best and why. Or you have an idea of who is serving a niche that has been ignored for a long time in Rihanna, right? Rihanna's doing that. That's her advantage. And so you see that as someone who's used the options out there, and you say, this is clearly better than everyone else. This is gonna work. I want a piece of this. And you invest in it. That's what I'm doing with SoFi. I use SoFi. I'm an engineer as well, so I can understand the advantages of Galileo. Just like Peter Lynch says, that's your advantage. If you use the things you invest in, you know better than Wall Street. You know better than the hedge funds. And number five, this is going to be our last one because I should get to sleep. Number 5 is that you are there before they are. The hedge funds won't touch anything new. Remember, new means risk, and risk means a potential to lose client money. And we can't do that. Our first mandate is to not lose client money. And so as a hedge fund, we're going to wait on this island a little bit. We're going to wait over here for a little bit and see how this plays out. This company is SoFi. It's very risky. Let's just hold off a little bit and see what happens. This company, Tesla, very risky. Let's hold off a little bit and see what happens. Amazon, let's hold off a little bit, see what happens. When they de-risk a little bit more, then we'll have permission from our clients to go invest in that. And so retail investors have all that time. This is what Peter Lynch says. Retail investors have time before the hedge funds notice these growth companies. You have time to invest in them. In ups and downs, right? You're going to have many cycles of ups and downs before the hedge funds notice. And so a company like SoFi, for a long time, they were mostly retail investors, and they still are, at least from my last check. And my friend told me, this is nothing my friend told me, my hedge fund friend, told me that you're not dealing with amateurs, dude. You're dealing with professionals, very smart people. And I just completely lapsed. I didn't really rebuttal because I wasn't thinking about it. But that's not true. My top investment is mostly retail investors at this moment and for a long time. And I've been buying into it for far before most hedge funds even considered it. And now as the stock goes down, I am not selling out. But guess who is? Other retail investors who don't know as much as I do, who don't believe as much as I do, who don't understand as much as I do, right? They don't follow the bull mentality, but I do. I have time. I have the resources, and I know that I invest in money that I am willing to lose, that I am willing to not touch for a while, for years. And so I'm coasting. And so I can dollar cost average in. I bought at 15. I'm going to buy at 5. I'm going to hold on at 6. I'm going to hold on at 4. I'm going to buy more at 7 and 8 and 10 and then 5 if it goes back down. I'm going to dollar cost average in, while my competition exits the dip, or they stay in the cul-de-sac. We've covered this. Buy the dips, sell the cul-de-sacs. If you haven't seen that video, go watch it. It's very important. So my competition is either going to leave or just stand still. They bought at the all-time highs, but are too afraid to buy the all-time lows. But I'm not. I make a pretty steady salary, and I have a pretty good fallback if things go wrong. And I have only invested money that I'm not willing to. I don't need to touch for years, so I can just continue to hold on to what I already invested and buy at all-time lows. But my competition exits the dip or stays in the cul-de-sac. And what that means is that if I take advantage of this dip, if I buy the dip, then I will be one of the few who make it to the top and realize outsized returns because I got in before the hedge funds came in. And when they came in, as they're doing now, because the dip is so lucrative, they're buying a dip. As they do that, I'm buying a dip too. They call themselves very smart people. I'm going to watch their best moves, ignore their dumb moves, as in selling great companies because they're down, because their clients are afraid of losing money. And I'm going to hold on. I'm going to buy when they buy. I'm going to hold on when they sell, because I still believe in the company. I'm still convicted. That's my advantage. I understand the company, and I'm willing to hold on, and I'm willing to get there before they do, and then continue to buy in, ups and downs. It's been a while, so I haven't done a video. I want to just come out here and share my thoughts on this conversation that my friend and I had. I hope this has been helpful in some way to you. I will eventually do a video that is more concise. I apologize if you're not the type of person who enjoys my rants. But if you are that type of person, I hope you enjoy this one. I have lots. This conversation I had with this friend, this hedge fund friend, very eye-opening, very enlightening. It's going to give me content for months and months to come. So this isn't the last you're going to hear about this hedge fund friend of mine. And I actually would like him to come on the channel and share his thoughts, because I don't mind having competing ideas. It makes us all better. So that conversation I had with him, although he disagreed with my approach, my strategy, it made me more convicted in my strategy, because I now understand him better. I understand his world better, his world of wealth preservation better. And so now I know that they are weak when it comes to my realm of wealth growth, wealth building, because I have the advantage. 10x for me is a big deal. 10x for him is impossible. I can do even 50% in a year. I can do 100%. I can do even 200% in a year. Warren Buffett said if he was managing less money, say $50 million, he would do 50% every year. Because that's just math. 50% of 50 million is $25 million. That's much easier than turning 50% of $100 billion, which would be 150. So you go from 100 to 150 billion dollars. $1 billion is a lot of money. You can't even conceive of how big it is, because you've never seen anything like it. You can't even fathom that idea, because you're broke. But you have an advantage because of that. And so you can turn your little stash of cash into double that and then 10x that, and it's still very small. So you 10x it again, and you 10x it again, and it's still very small, and you 10x it again, and then you just say, hey, I can retire now at 40, 50, even 60 before my S&P 500 friends get around to their retirement at 65, 70, 80, or never. Or never. Or never. Because they looked for the best risk-adjusted returns. Because that's very smart people who believe in absolute market efficiencies say. Yeah. And I'm not saying my friend believes in that. He did concede that the market is not perfectly efficient. There's inefficiencies, and we're seeing it now. Very good businesses are being sold at great discounts. And this is not the first time this has happened, and the last time it's going to happen. So that's your advantage. If you can see that, you can see that the market has inefficiencies, and you can take advantage of those, then you have so much opportunity, so much potential, upside potential. It's asymmetric. Asymmetric risk is the holy grail. We've covered that, and you should go watch that video. So I'm going to continue. I'm just going on and on because, again, I told you there's lots of content that I have to bring out from this conversation. So I want to thank my friend. He knows who he is, but I don't want to say anything more about him because I don't want his hedge fund to get upset. I hope you're enjoying your slumber, and I hope you enjoy this video when you do see it. I'll see you again soon. You have been watching bullacademy.org on YouTube, where we teach long-term investing by breaking down concepts and sharing the stories of companies to help you build long-lasting sustainable wealth. We hope you enjoyed this video, and if you did and want to see more like it, please remember to like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts on this topic, even if you just want to say hi. Hi. I would love to hear from you, and I always do my best to respond to every comment. If you would like to engage with me outside of YouTube, feel free to follow me over on Instagram at Lincoln W. Daniel, where I share random thoughts on life and wealth building. As always, this video has been brought to you by our patrons at patreon.bullacademy.org, who support this channel financially to help us keep going and help me brainstorm new video ideas to share with all of you. We do the show together, and we do all of this in our private Discord chat where we discuss the stock market in real time every day by sharing news, rumors, and new investment ideas so we can all do our own research and then come back together and collaborate. So if you're interested in any of that, I hope you'll join us over at patreon.bullacademy.org. I'm Lincoln with bullacademy.org. Thank you again, and have a great day.